Hi everyone, Lori Montoya with Santa Fe Realty Unlimited. I'm here today with Robert Hill, and he's going to clear up some information regarding mortgage insurance. So, hi Robert, how are you today?
How's it going? Glad to be back, Lori.
Good, good. So, if you can kind of clear up some questions about mortgage insurance, first off, what exactly is mortgage insurance?
So, mortgage insurance, in a nutshell, if you aren't putting 20% down, essentially for a conventional loan, then you're paying mortgage insurance. Now, we've talked about the four main loan types: VA, USDA, FHA, and conventional. We're going to talk mainly about FHA and conventional today because those are the types where you will have mortgage insurance. And more specifically, we're going to talk about conventional because with an FHA loan, it is what it is. It's government insurance. There's no picking it. There's no ifs, ands, or buts. It's going to be on for the life of the loan if you don't have 10% or more that you've put down. So that's just something to consider about an FHA loan. And that's, in a nutshell, like what mortgage insurance is. You're going to pay it on your monthly payment if you didn't put 20% down.
Okay, great. So, if you get a loan and you're paying mortgage insurance, can you get rid of it?
Yes. If you have a conventional loan.
Okay. So how would one get rid of it? What is the process? Because obviously, if they're not paying mortgage insurance, their monthly payment's going to go down, correct?
Right. Absolutely. That is something, whenever I'm pre-qualifying someone, I want to make sure not just that they know the process on how to get rid of the mortgage insurance, but when, more specifically. So at some point, obviously, the best way to think of it is if you're putting 20% down, you don't need it, right? Well, that means you're at 80% loan to value, LTV. At that point, it's going to fall off, or at least it should. More specifically, it's going to fall off automatically at 78% loan to value. So when you have 22% equity in the property, it should fall off. Does it always? No, I'm not, because I've seen cases where people have had 60, 70% loan to value and they're still paying mortgage insurance. That's something that you will have to probably ping your lender, most likely, whoever you close with, and ask them, what mortgage insurance company did you stick me with, and like, how do I get rid of it? That's going to be your main question. That's where you start, because not all lenders use the same mortgage insurance companies, and there's at least 5 to 7 I know for a fact that Van Dyke Mortgage uses that I can pick from. And on a general sense, whenever I'm pre-approving someone, or once we get to the closing table at the very least, I've just then picked the cheapest option available for that person, just because that's our fiduciary obligation, is the best benefit for the buyer, right?
Mm-hmm.
Is to get the cheapest one out there, basically. So if I circle back to the answer to the question, is how to get rid of it, right? Step number 1 is to find out what mortgage insurance company it is that you are using, and then essentially go from there. And you can look these people up. Obviously, they all have websites, and they should have instructions on how to get rid of it.
Okay. So basically, once somebody gets into a loan, they're going to have to find out who their mortgage insurance is with, and they have to keep an eye on that themselves to make sure that they get that insurance company to stop charging them the insurance once they've hit their loan to value of 20%. Am I correct?
Precisely, yeah. And you can call to get that requested or go through that process at that 80% loan to value, so 20% equity. But it should fall off after 22% equity, 78% loan to value.
Great, great. So for my understanding, I mean, I'm trying to think of any other questions that might be helpful to our viewers out there, because right now it seems pretty basic of what you're telling me. So people are going to get a loan. If they don't have 20% down, they're going to have mortgage insurance. Once they get 20% of value of their home, then they can drop it, is the main thing that we're getting out of this today. Is there anything more, something that I might be missing to ask you that our watchers, our viewers out there will want to know?
Yeah, actually, honestly, if I could give any advice to anybody out there, it's don't stress about it. Don't worry about it too much. I think sometimes people get that in their head. Oh, I'm paying extra money a month more than I need to. But really just think about, where is future me going to be? The reason I say that is because I think statistically, people buy and sell homes anywhere between like 7 years. So like statistically, you're probably not going to keep that home for longer than 7 years, right?
Mm-hmm.
And typically, if you have a conventional loan where that MI will fall off at some point, then you probably have already reached that point, maybe 3 to 5 years in, depending on how much you put down. Well, then you're probably already having plans to put it up as a rental, or sell it at that point anyways. And the reason I say that is because at some point, if you do go to like refinance it, obviously your lender is going to look out for you and say, hey, look, you're at a point where the value, and that's the other tricky thing too, is what is the home's value? Because obviously when you get it appraised when you buy it, but a year, 5 years down the road, it might appreciate a little bit more and be higher, just based on market analysis. So that's something to consider as well, that it might fall off sooner than you think, just based on the value and the fact that that value then increased higher than what you bought it at.
Yeah.
So that's something to consider. And also, the reason why I say don't stress about it is because you might have a particular buyer that might be waiting to get, they say, oh, I want a conventional loan and put 20% down so I don't have to pay mortgage insurance. Well, how long are you waiting to put down that 20%? Because that could be a lot of freaking money, right? And that's not
Yeah, especially when you're looking at
the
homes for
easiest to save up.
Santa Fe. If you buy a home for 400,000 at 20%, that's a good chunk of savings that you have to have ready.
Absolutely. Right, exactly. So if they're sitting there waiting another 3 to 5 years just to save up that much, well, then they kind of maybe missed out on some equity that they could have been building, and the value, like we just talked about, they could have been building in the meantime anyways, and just have that taken off. So that's another reason why don't stress about the mortgage insurance. Just try and wrap your head around it enough and get as much information as you can from your lender. Like we just talked about, specifically, what company am I using? Am I using Radian, Genworth, these companies you've never heard of, to get that mortgage insurance? So that way, when you're ready to cash in or make that call or submit that online request to get it removed, you know who to talk to.
I have one other question for you, Robert. Can you give me a
Mhm.
general idea of how much mortgage insurance is?
That's also a great question, because it's calculated very much like normal insurance is calculated, with all kinds of weird algorithms and things, and even talking about interest rate too, like what makes an interest rate. It's not just based on your credit score. It's not just based on, I think, some of the other few things that people may know, like loan to value. Just talked
Mm-hmm.
about that, right? It's based on a lot of different risk factors. So debt to income ratio too, as well. That will play into a factor on whether you can or can't get financed because of your mortgage insurance, or just finance in general due to guidelines. But that's the gist of what I can say on the why. But how much it actually is, I'd say you can estimate for about $160,000 property, about $90 to like $110 a month.
Mm-hmm.
So take that ballpark of like $160,000 property to like a $250,000 property. That's going to be your ballpark. You might be even in the upwards of like $150 a month or something like that. And that's the other thing too, is hopefully your lender is also looking out for you for, if not first-time homebuyer programs, also some other programs like Freddie Mac's Home One. So that's another first-time buyer one. Some of them, like Fannie Mae's Home Ready, you don't have to be a first-time buyer. But these programs I just mentioned, they have discounts on how they calculate your mortgage insurance. So just because I say if you put 3% down and your mortgage insurance is calculated at 35%, that almost means nothing to you. That doesn't mean that it's calculated at 35% of the loan amount or whatever. It's just like a weird, like I mentioned, all these other factors involved. That's what we as the lender go off of. So if I see 35%, I'm going to look at the programs that say 25%. And then also, like we mentioned, it's cheaper as the more down payment that you put. You can think of it as every 5% that you put down the lower your MI is going to be. So again, don't worry about putting 20% down just to get rid of it. Maybe it might even actually behoove you to put 15% down. Have a little bit of MI at the front. It's going to fall off, like we just talked about a little bit, within a couple of payments, and you may have gotten a lower rate because you put 15 as opposed to 20 down. That's what I look into for my buyers. Maybe it might make sense if you're really rate conscious to put 15% down or even 25% down if you have it, if you're at that point. But that's the thing. It's like I'm always constantly looking at those things. So again, just let your lender do the heavy work as far as MI goes, and just ask the right questions. And in my mind, it's what MI company do I need to talk to get this removed?
Yeah, and that makes a lot of sense to me because, I mean, I don't do your job, so it's like trust the experts and ask questions. If you don't know something, ask, because if you have a good lender, they're going to be honest and upfront with you and to be able to explain it the best way they can, so you feel comfortable.
Oh, absolutely.
Well, thank you so much. I think this is really powerful for people to learn a little bit more about mortgage insurance and that you can actually take it off if you're on a conventional loan.